Hello, everyone, and welcome to this session of the Siegel, Bryant & Hamill Investment Summit. My name is Dan McCormick, and I'm here with Scott Decatur, the Director of International Strategies, and Suresh Rajagopal, our Director of Global All-Cap Strategies and ESG Research. Today, we're going to focus on non-U.S. and global market opportunities. So, Scott, let me begin with you. Last time that we chatted, you pointed out the relatively outsized opportunity set within non-U.S. developed and emerging markets. How has that played out for investors, and do you still see value there?
Yeah, we see those large valuation differences presenting a great opportunity for investors to diversify and include more non-U.S. holdings in their portfolios. And what we're seeing now, though, wasn't always the case. In fact, a decade ago, valuations actually favored U.S. stocks, and that subsequently played out well for U.S. stocks for many years, leading to where we are today.
Well, many investors have seen these rather dramatic valuations, but they want to know, when will non-U.S. stocks start winning?
Yeah, understandably. But we've actually started to see this happen already over the last couple of years. If we look back to 2022, the MSCI EAFE index, the main developed markets large cap index, beat the S&P 500 by over 4 percentage points. And this year, the S&P 500 has been delivering nice returns, but almost all of those returns have been driven by a small group of stocks that are now known as the Magnificent Seven. But if you step back and you look at the rest of the S&P 500, the broader U.S. market, the returns look pretty mediocre, with EAFE ahead again by about 4% and EM large caps in line with that broader U.S. market. You know, we can't just exclude those Magnificent Seven, but it's important for investors to understand just how narrow any perceived U.S. return dominance really is. When we look down at the small cap space, developed market small caps are slightly ahead of the Russell 2000, and emerging market small caps, they're actually returning almost 10% better than the Russell 2000. So these are all promising signs. And we think the period of dominance by non-U.S. markets is actually just getting started. You know, these cycles have typically run for about a decade or even longer, and current valuations would seem to confirm that we're really early in the upswing for international markets.
So do you feel this current value and quality set of opportunities within markets, how do you think they stack up relative to history?
Right. So within the international markets, cheaper value stocks are at historically attractive levels versus the market itself. You know, a lot of the froth in the markets over the last couple of years that we saw in the exciting, expensive growth companies, it's still there actually. But that in turn is creating large pockets of opportunity to buy very good companies, you know, some might even say boring companies, at great prices. You know, what's even more interesting is that much of this opportunity of stocks with good value is actually in higher quality stocks. So for example, in our international small cap portfolio, our stocks are trading at nearly 40% discount versus the market, but our portfolio companies have roughly a 30% higher profitability level. And you know, we see similar situations in each of our strategies, large and small, developed and emerging, where in each case we have large valuation discounts, but more profitable companies than their respective markets. So you know, we think this is a great opportunity to get some diversification to go along with one's U.S. equities, while picking up higher quality companies that are trading at really depressed levels.
Okay, thanks, Scott. Suresh, two-part question for you. First, regarding the value opportunities globally, would you agree with Scott's comments? And then tell us more about where your team is finding value in the U.S. and overseas markets for your global portfolios.
Sure, Dan, thanks. As the viewers may be aware, the global strategy invests in both the U.S. and outside the U.S. marketplace. We are concentrated from a holdings perspective as we're a stock selection-driven strategy with more of a core growth bias, I would say. We invest in developed markets and are currently overweight the outside U.S. marketplace relative to the U.S. market. So I would say I agree with Scott on valuations. We're finding stocks, quality companies at a discount to our valuation work. We're finding quality stocks across the market capitalization, geographic regions in the U.S., Europe, and the Asia Pacific marketplaces. We're finding companies that are of high quality and trading at a discount to our valuation work, which is important to us. Our belief is that the market volatility that's being caused by higher interest rates, inflation, and the decoupling of the global supply chain will continue. And investing in quality companies that are at a discount to valuation will provide a long-term upside.
Okay, thanks, Suresh. Well, that concludes today's session. Thank you, Scott and Suresh, for those valuable insights. And thank you, everyone, for joining us. Please reach out to me and or any of your SBH contacts for more information. Have a great day.